Looks like everyone's rolling in. We should be starting in the next 3 to 5 minutes. Tonight should be very interesting. How you doing, Jay?
Yeah, I'm good. How are y'all?
I'm doing good. We trying something new today. I have the live going on.
Looks like
Facebook.
Everyone's rolling in. We should be starting in the next 3 to 5 minutes.
We going live on YouTube and Facebook at the same time or something?
We trying something new today.
Mm-hmm.
Turn the volume off so you can kill the feedback. Turn the volume off so you can kill the feedback. Y'all see Geo? That's what Tesla money look like.
I'm over here watching the game.
Why was it an echo?
It's probably the playback from your YouTube. You probably gotta turn the volume off or something. I don't know.
I did. Let me make you the host, co-host. Okay, we can get started now. We got ready.
Okay, hey, Brandon, if you want to go to the first slide, if y'all have anything to say, I'm ready.
All right, we good to go?
Yeah, all right. Okay, so here's what we're going over tonight. We're going to go over what is quadruple witching. We're going to go over some options, strike prices you can go into. We're also going to go over individual stocks and ETFs you can do if you're not yet doing options yet along with us while we're doing the rolling forwards. You can do the same thing with stocks. And then we're going to go over some companies on our watch list, and then you guys can ask questions. And feel free to stop along the way and like wave your hand so one of us know if you have questions during the presentation. And so quad witching occurs as 4 different types of assets expire in the financial markets at one time. So you have derivative instruments such as options, futures, commodities, and other things expire on one set day. So say, for example, like all of the index options will expire, all of the futures options will expire, all of the commodities will expire, and then new options contracts will be created. So, for example, the S&P 500 has options that expire Friday, and new options will be made anew in the market, and this sometimes causes volatility because the big institutions, the hedge funds, are getting out ahead of the time and they're rolling their options into new positions. They're also, if they had a loss on anything, they're selling for tax loss harvesting. They're getting ready to get ready for the new year in 2021. So this is why you can see a lot of choppiness in the market and see a lot of indecision as we go to this month of this last part of December until the quad witching is over. You're going to see like big ups and downs. You might see the SPY down 1 or 2% here in the next couple of days, just as these hedge funds and big banks and everything are unloading their positions and preparing to get into new ones. So it's not really important as far as it doesn't make or break your gains or anything. It's not something that you have to jump right into. It's just a set date. It kind of brings the quarter to an end. It's just showing you that all right, one quarter is ending and a new one is beginning, and you get the opportunity to invest in longer dated options, or even just any options that are new. Even if it's like a 6-month option or a 3-month option, you get the ability to have that option on the option chain as a choice to you when the quadruple witching occurs. So what is a strike price? So in an option, you have the right but not the obligation to buy a stock at a set price at a given time frame. So for example, one of our strikes is the technology sector. That's the XLK Spider Select ETF. We are paying for the right but not the obligation to be able to buy XLK at $155 in 2023. So we have the right, but not the obligation. So we have control of everything, but we don't own it. So we have control. We're paying for the control of XLK for a set period of time frame, unless we choose to exercise our option and own it for a much cheaper price in the future when 2023 does come around. And so options go both up and down. So a call option, you are expecting the underlying stock to go up, and you're betting with leverage that the stock is basically going to go up with an option contract. And the same things for puts. You expect the underlying stock to go down, and you're betting with leverage that's going to go down to amplify your gains. So some of the current strike prices the forward thinkers are looking at, we have the XLK 155 strike, the ARKK 167 strike, the SMH 275 to 280 strike, and the XLY 185 to 205 strike. If you're approved for options in your brokerage and you pull these up, you can look over the prices. Some of them are cheaper than others, but you should be able to get that XLK strike for around 700 or a little bit less than 700 right now, which is a good price. And if you just put up that 700 and it does 500%, you're looking at $3,500 off a $700 investment.
Hey, so Jay, quick question. How are you calculating these strike prices?
That's a great question. So if you go to the next slide, we can actually go over how to calculate the strike price formula now, and I'll share my screen, and then we can get into the watch list as well. So
Yeah, you about to share your screen right now? I can start.
Yeah, let me share my screen.
Okay.
So we're going to go to barchart.com. We are going to type in the example of the stock or the ETF that we're searching for. So for simplicity's sake, we're going to type in XLK. The current price as of the last market close was 124.75. So we're going to round that up to 125 for simplicity's sake. If it was 124.4, we will round it down to 124. Since it's 124.75, we're going to round it up to 125. So we're going to go to performance report. And we're going to look at the performance history. So over the last 2 years, XLK has done 93.2% or 60.18%. And we're looking at the 2-year performance because that's how long our position is. So the January 2023 strikes are actually 2 years. If we were looking, if the position was, say, if our strike price was 2.5 years, we would look at the 3-year performance because we round that up. So we're going to round up. If it's 5 or more, up the score. 4 or less, let it rest. So we're looking for how long. We're going to look at how long the option is, and then we're going to divide by how long we're going to stay in the position. So since it's a 2-year option, we're going to stay in the option for 1.5 years. So you see that 60.18, we're going to round that down to 60, and we're going to do $60 divided by 1.5 years. So 1.5. So we're going to do 60 divided by 1.5. So 60 divided by 1.5 equals $40. And from that $40, we're going to factor in a 10% correction per year. So the market typically has a correction or drawdown of 10% each year. So we're factoring that into our equation. So if you ever see the market pull back when you're in these options, you already factored it into your equation. So you don't have to worry about it in the future because you're doing it now in the beginning. So you're going to do 40 times 0.08. And how I got the 0.08 is you do 100 minus 20, and that gives you 80. In decimal format, that's 0.08. So you do times. If you're using like an individual stock, you might want to do times 0.6 or times 0.7 because they're going to move more violently than the ETF is going to move. So if I was using Tesla, I might use 0.6 or 0.7 or 0.5 just because it moves so much, and the correction could be a lot steeper. But for an individual stock like X or ETF like XLK, we're going to do 40 times 0.8. That gives us 32. And we're going to do 125, the current stock price, we're going to do 125 plus 32 gives us 157. So the price changed a little bit. So we can actually do the 155 strike all the way pretty much up to the 160 strike. Any questions on it? Any questions? Would you guys like to see another example?
Yeah, run that again one more time.
All right, let's use a different stocks. Let's use XLY. So the current stock price is 156.53. I'm going to round that up to 157. We're going to go to the 2-year performance because we're looking at a January 2023 call. So that we have 2 years left at this time of the recording. You always look at the performance based on how long the option expiration is. So if I was looking at a 6-month option, I'm going to go to the 6-month performance, and then I'm going to only stay in the option half the time. So I'm going to get out in 3 months. So I'm going to divide the performance by 2. And if I was in a year, if I'm looking at a yearly option, I'm going to divide by 6 or divide by 2 because I'm only going to stay in 6 months, and so on and so forth. But for the 2-year performance for XLY, we have 54.20. So I'm going to round that down to 54. I'm going to do 54 divided by 1.5. That gives us 36. times 0.8. That gives us 28.8. I'm going to round it up to 29. I'm going to do 29 plus 157. So 157 plus 29 gives us a 186 strike. That's with a 20% correction. Now, if we were to do 10% correction, it's going to change the strike a little bit. So we do, for example, 10% correction would be 54 times 0.9. That's going to give us 49. I'm going to round that 48.6 to 49. And we're going to do 49 divided by 1.5. That gives us 32.6. We're going to round that up to 33. We're going to do 157 plus 33. That gives us the 190 strike.
Hey,
So
and Jay, question: how often should you calculate the strike price? Does it stay consistent? Or do you need to recalculate?
So, if you're like, I look at the price. So, like, say for example, I create a price range for myself, but you can literally create calculate the strike price before you buy an option every time. But say like XLK, say XLK options open up at 1800 and they go all the way down. They have a low of 1200. Well, I'll basically just use that same 130 strike that I selected, and I'll average down, or I'll even be willing to average up. Can somebody mute their mic? Thank you. So say you're in the XLK 130, the option might open up at 1800 and it go down to 1200. Well, I know the high is 1800 and the low is 1200. I'm willing to, for like say the first 2 months, I'm just saying I'm willing to pay anything up to 1800, and then once it breaks new highs and it goes to like 1820, that's my cue to stop buying. Like the fair value price for me is 1800, so I'm gonna stop buying there. So right now, if you guys start buying the 155 strike and you buy it at $7 and it goes down to $5 and you have another 500, just keep buying that XLK 155 strike until say it goes past $800. Once it goes past $800, stop buying it and just sit and be happy with your gains and let it keep going. And then if you were looking to buy another contract in the future, maybe buy a different sector or look to redo your strike price formula. Any questions on that?
So how does these prices kind of go in the same stop? How does these stock prices change according to quadruple witching? Like, are we able to buy further out contracts at a cheaper rate, or are we just buying another contract further out?
So depending on how far the chain extends, it doesn't change the price unless the market is just down that day. You might get your options contract that you were trying to get for a cheaper price, but it's really just expanding the option change or putting new options on the market. So it's not necessarily you're getting a better price at quadruple witching than waiting to do it afterwards. It's just giving you a kind of a point where, all right, I need to start looking for new positions in each quarter of the year. So I need to start looking for new positions in September. I need to start looking for new positions in December. Then I'll start looking for new positions again in March, and so on and so forth. But I was going to show you guys one last thing. So you can actually look at to kind of know how much you're paying for an option. You can look at the options history. So if we're looking at XLY, if we go to options prices, we're going to go to the 2023s. We're going to go to show all. And let's look at the, let's look at the 185 strike. So I'm going to click on options chart. And you see you can turn the Bollinger Bands on. So see here the Bollinger Bands are. It's not at the top of the bands, but it's kind of close. So the options high here has been well, it's pretty much at its all-time high. So this might not be the best time for us to buy this option. We might wait for a pullback, but you still have to think kind of fundamentally and think what's driving XLY right now. Well, XLY has Tesla coming into the ETF on December 18th. It has Amazon's earnings, Nike's earnings, McDonald's earnings, Home Depot's earnings coming up for Q4. That could be a potential positive catalyst, and as well as it also has the vaccine news coming out. So 2021 people are going to be looking to go back into Starbucks more aggressively, buy more Nike clothes and shoes because they might get to go outside a little bit more. So it has all those tailwinds for it. But you can look at any option. So you could do this for Tesla. You could do this for Amazon. You could do this for Microsoft. So any option. So just another example. Let's look at Microsoft. Let's look at another one I was looking at recently is so let's look at the 2022, like a 2022 trade. Let's look at the January 2022. I'm going to do show all. I'm going to go to the 260 strike. And look at that. It has 12,475 contracts open. So somebody's getting in there. So that's something to take note of. You see it's currently trading at 1076, and it's been all the way as high as up to 3,000. So I'm kind of getting this contract at a steal, so I can know, all right, its low is around, maybe $5, but I'm getting it at a good low. It's been all the way at $3,000, so I'm getting it $2,000 off, or $1,050 off. So I'm getting it at a pretty good price. And if it just goes back to 3,000, I know I made $1,200, for example. I know I got that locked in just by looking at the chart and seeing, is Microsoft going to go up a little bit in 2021? I would think so. And I'm going to get a premium appreciation because of that in my option. And say if we put the Bollinger Bands on there, it's trading at near the bottom of the bands. Or yeah, so you can kind of see this option has been in a downtrend. So we could expect into 2021, Microsoft has strong seasonality in January for a bounce. So this might be something worth looking into. Any additional questions, guys? Any questions at all? And if you're scared to talk, put your question in the chat and we'll answer.
Did you say XLY is at an all-time high right now?
Yeah, XLY is pretty much at an all-time high right now. Mm-hmm.
So if XLY is at all-time high, why would we want to invest into that in our strike price formula? Like, wouldn't
Well, you have the catalyst of Tesla, the highest performing stock in the market, coming into XLY, and you are essentially positioning for that before it happens. So though it's kind of at the highs, you're getting into a 2023 with a lot of time, or a 2022, either or. You have a lot of time. Tesla's going to be coming in and it's going to be boosting its performance. So what you have in the stock market, what's called multiple expansion. Well, imagine Amazon, which XLY and XLK's performance are pretty close right now with just Amazon. So imagine Amazon and Tesla versus Microsoft and Apple. Who are you taking? Because I'm taking Amazon and Tesla.
I agree. I think I'll be taking the same thing. My thing is, although it's quadruple, looking for a further out contract, would it not be best to wait for the market to do a small pullback and then that to happen?
You certainly can wait for a pullback. I wouldn't necessarily be looking for an aggressive pullback, because you have to think, though. I wouldn't necessarily be thinking for too much of a pullback. I would look for a pullback to like the 8-day exponential moving average or the 21-day exponential moving average. From there, if you get like a pullback to like the 21-day EMA, I would definitely be looking to buy XLY hand over fist into 2021, because it has a lot of catalyst. And if we do see a return to somewhat more normalcy, the economy should be recovering, and maybe a stimulus bill being passed soon. That's going to affect more so the companies in the XLY more so than it will the XLK. Like, technology will always be bread and butter, but XLY, it has Amazon, it has Tesla, it has Home Depot, but it also has those companies like that McDonald's, the TJ Maxx, the Marshalls, the Ross. It has all those stores that are a reopening play, but are retail and not affected by technology, but more so like money's coming into the consumer's hands and they want to buy a TV from Amazon, or they want to go to Ross and spend $100 in there and get them a couple outfits. So that's how I look at XLY. I look at it as diversification from my XLK. And as well as ARC. The market as a whole is kind of at the highs. So you guys don't have to rush to buy during quadruple witching. You just need to know, all right, if you do buy, be prepared to potentially buy again and just get your position set. Because I would advise you to buy now versus trying to wait for the perfect entry if you haven't been practicing your entries. Just buy and wait, and you if we're talking about 500% return, like, so don't get so in your head about it. But yes, the market could pull back in the short term. It is kind of at its highs, but always action over inaction. Don't be scared of a market pullback because you're already factoring it into your formula.
Consider that Amazon is already at near its 50-day, so it's got a lot of room to take off. And if Amazon takes off, XLY is going to take off. So even though it's sitting at the highs get broken all the time. So a new high is going to get taken out by a previous high. And if it pulls back, it just pull back to where it was now, potentially. So it's really not going to matter in the long term, 2 to 3 years from now, when you got in. It's just that you got in and let it cook.
That makes sense. I think we got a lot of people from the stock group chat in here. Does everyone at least have some type of leap or position going into the new year? See some thumbs up, see something in the chat. Let's get some responses.
Yeah, I'm in XLY.
I'm in XLY as well. I have about 2 contracts of XLY, trying to pick up more this week.
I might be buying 2 contracts of XLY tomorrow. Well, I will be buying 2 contracts tomorrow.
Yeah, speaking into existence.
And Brandon, can you bring up the slide again that brings to our next point? If you're not comfortable with options yet, or you just feel like 700, 1,000 is steep, which it is, you can buy the individual stocks, fractional or full shares, and do the same process with us. Your gains are going to be a little bit different, but I'm saying if you get 50% returns, 30% for the returns for the year with these stocks on this list, that's phenomenal. So a great example of a stock that I think is about to break out that's less than $100 is AMD. Buy some AMD for quiet witching. If you want to get into options but you can't, you're not ready, or it's expensive, buy a couple shares of AMD and just hold those and see where they are in a year. I think that a stock that's $100 could be 170, 200 in a year and a half. That would kind of be my price target range for AMD. Looking towards 170, $200. DraftKings, another good example of a kind of like a emerging stock that I think can do well. It's about $50. Grab you a couple of shares, and as the economy starts to reopen, more online sports betting is going to occur. You have things like the NCAA March Madness coming back next year. You have basketball becoming more normal. Maybe we get to go back into the stadiums and arenas. You have the Super Bowl. People are going to be betting on the Super Bowl. Another company, CrowdStrike. CrowdStrike is I think about like $150. Cybersecurity play. As we get more technologically sound, you want to be exposed to companies that are protecting the technology companies, because one thing you have to have is security. So all the big companies in the world need security for their cloud services. So CrowdStrike is a leader in the field, as well as Datadog, which I think Datadog might be like $95, $96. So you guys can definitely put up $100, at least buy one share of something, and to get your rolling forward started that way. And then you might buy one share this quarter, and then another share in March. So these are some of the picks on our list, and you can pick that. The ARK W or ARKK, just the stock is going to treat you nice if you buy that. Just the stock alone, let Kathy Woods do the work for you. She's a great stock picker, and you have all of her picks, and you just get to sit back and relax. Same thing as buying the option, just on a smaller scale, and you can make money that way. So buy some ARKK, buy some ARKW. Buy that. C Limited is a great stock. Netflix is a great stock. Amazon, of course, is a great stock. Square, Microsoft. Any of these on these lists, I believe in. It's just a way. I want to give you guys some value that you can pick from on the list.
I know you said there are going to be further out contracts available today, right?
So it's actually going to be Friday.
Okay.
It's actually going to be Friday. And we don't know if there are going to be further out contracts like 2024s yet. But we do know, like, say, for like ARKW, its option chain only goes to June right now. We do know that its option chain will at least extend, most likely, to the January 2023.
This Friday?
Yeah, this Friday. It should at least extend until the January 2023.
Okay.
So I'm looking at that one, for example.
What's the holdings in the next gen?
Let's look it up.
Square is one of the big ones. I like that a lot.
Yep. Square and Tesla, I know, are going to be the top 2, top 3. So the top holdings are Tesla, Roku, Square, Spotify, Teladoc, Pure Storage, Pinterest, Facebook, Twilio, Bitcoin, Fastly, C Limited, Tencent. So I do like its
You have
holdings.
holding Bitcoin?
Yep.
Damn.
And people always talk about Bitcoin. I don't buy actual physical Bitcoins. Well, not physical, of course, but I don't buy Bitcoin. I just buy art, so I'm exposed to Bitcoin because I'm not sold on it yet. But art got me covered, so I just buy art and let them take care of it. And they trade it and get in and out of it and make sure they get the right price. They do all their research, so I don't need to. I'm not really worrying about Bitcoin, but I'm making money off of it, so I'm exposed to it. So basically, I'm leveraging Bitcoin, but not owning it.
But definitely take a picture of that list and look at something you like. If you don't have the money for a long-term option, you can at least buy $50 of Square. If you can't do that, you don't want to buy it.
Hey Jay, what I'm gonna do is I'm gonna make the last 2 slides available. We'll probably put them on social media, but we'll also drop them in the group me as well.
For sure. I have some more picks too that I need to add, but
Okay.
yeah, for
That's
sure. And I didn't put the like VOO for the S&P 500 on there, but it's grandfathered in. Like, you obviously, if you don't know what to do, you can buy the S&P 500. You're owning everything. A modern day S&P 500 though is ARK, and it is a lot cheaper than the S&P 500. So me personally, I would recommend you guys buy something like an ARK or an XLK rather than the S&P 500, but you certainly can do that as well.
Yeah, I think I bought VOO maybe April, maybe not April, maybe May. I don't remember, but I'm up like 22% on it, which is cool.
Most definitely. And a lot of people in the chat, even though they're not talking, are up more than 100% on their options. So it's not pie in the sky.
I won't be a shy guy. I think one of the plays that we talked about, early September, is the same one that is on our watch list, that ARKK. Personally, on one of my ARKKs, I think I'm up about 144%, and it's only been like 30 days. So that's like one of my golden children right now.
Mm.
I think one of
oh,
yeah.
You got it, Duck.
No, go ahead, bro. I was gonna say one of the best things to do, even if you don't have a lot to say in the chat, is just simply, listening sometimes. Listening will take you a long ways.
Not only listening though, listen and act on it. Because I had a problem with that. I'd listen all day, but I wasn't making no moves. But since I made a move, I bought the ARK contract like maybe 2 weeks ago, 2.5 weeks ago tops. I'm up 76%. And that just was mind blowing. I ain't gonna lie. So I'm all sold.
Say that again. 76% in 2 weeks.
Yeah, it's like
that's
2.5 weeks.
The average market performance, the average S&P 500 return is 10%. So you got 10%. So you do that times 5. You got 5 years of growth in 2 weeks.
Yeah, it was crazy.
And
That's
I
how I
bought
was feeling with
mine.
Hero.
You said what?
That's how I was feeling with Hero. I be listening
Yeah.
to everything y'all say, and I be moving on it.
Yeah, same here. I bought ARC about 2.5 weeks ago, and I'm up 81.99% in about 2.5 weeks.
So I'm up 145-ish% on ARC as well. Probably about 15% on XLK and like 8 to 10% on XLY. So, and this hasn't been longer than 2 months that we've been in these options. We've only been in XLK has been the longest, and we only got an XLK in September. So only 2 months really that we've been in there. So we're talking about 100% return in 2 months. You know, you can't beat that, and that's not guaranteed or anything, but it does over time. You will outperform with options versus stock, but you're gonna outperform if you're just in any of these stocks listed on here versus just what the general market, what everybody else is telling you to invest in. So,
And to be a little more transparent, to actually put numbers to what we're saying, if you bought ARC about a month or two ago, you're probably up about $2,000 or $3,000, $4,000 to kind of be more transparent. So you can actually see if you'd have spent around $1,500 like 2 months ago, that $1,500 would have been like $5,000 right now, almost $5,000.
Must be nice.
We're talking ARC ARKK, correct?
Yes, ARKK.
And one thing about XLY, it only costs a couple $100, right? It costs.
don't be surprised when it's
400.
don't be surprised when it's
ARKK.
$1,000.
Yeah, XLY is 400 right now. It ended today at like $4 to buy. So 4 times $400 for one contract.
Trust me, I'm trying to buy some more. I'm trying to buy
2022?
10 contracts tomorrow. I'm trying to buy 10 this week.
Definitely think with the promise of
hasn't ran yet, but it's going to be. You're probably going to be selling XLK. You're buying that for 700, and you might be selling it for like 7,000. You know,
Well, XLY.
No, XLK, like that XLK 155. If anyone buys that XLK 155, you might buy it for 700 and sell it for 5,000 to 7,000. So it you know, numbers
Hey,
a little
Brandon,
different.
can you go back to the slide where he was talking about the XLY, XLK? Yeah, right there. So you said the XLK strike price of 155 is around 700 right now.
Yes, sir.
Let me check.
Hey, but what is that? Is that 2023 or 2022? 2023, right?
2023.
All right, hold on. I'm about to look real quick.
Me as well. $155.
Where y'all looking?
On Robinhood
On my
or
broker.
any option chain you have.
Yeah, it's at 715 or 17.
Yeah, 17.
So
I'll have to buy some of that. I'm gonna
do
sell my car.
we go off the bid or the ask price?
So you're gonna go off the ask, but
That's what I thought.
I like to look at the last price, and I also like to look at the mid price. So I'll normally put a limit order in for my options. So if the ask says 710 and the bid says 685, I'm gonna try to get filled at 705.
That makes sense. That's probably that's probably something that I should start doing because that makes more sense.
But I mean, it doesn't matter. It's not gonna matter over the long run. But like that's kind of what I do. I look at the mid price, or I look at or I try to fill it in. Like if the ask is, unless the options chain is really tight, like the leaps are they're like they have a wider spread. So I try to you could have a spread of like $40, $100. So I try to get filled in the middle. So let's say the ask is 1785, and the bid is 1725. I'm at least try to get filled at 1740.
Chicken with green beans.
Hey, Jay, can you one more time show us how to read that? How much time do we have? We have 8 minutes. Can you go back over how to read the barchart.com whenever you're looking at the options?
Like the options chart.
Yeah.
So if we go
Can you look at
to
ARKW for this one?
sure, but I can go to like the longest strike they have out. They don't have a 2023 out yet, but
Oh, that's right.
it doesn't matter. It's gonna show like the same thing, but for the options chart anyway.
I just wanted to see because I'm looking at it right now. I'm not looking at the chart though.
So
We
like
got questions in the chat.
if we go to options prices, we go to let's do this 621. We go to show all. Let's go to the furthest strike they have out. So like the 215 strike options. Oh, I messed it up. My goodness. What questions do we have?
We answered the question, but he asked the XLY contract was it for 2023 or 2022, and I let him know it's for 2022.
So this is not a good example. This has been straight up.
Okay.
this contract opened at 330 and it's now 280. But that's why you don't. It's too far out. You know, it's too close. Let me look at a different one. Let's look at the XLK 130 for example.
That XLY strike was for 2023.
No, well, one of the 205 is for 2022, and then the 185 to 205, the other one was for 2023. So you'll be fine in either or, really.
Note that the 2022 XLY is a different type of option play. It's not. We're not planning to stay in it the whole time for it to actually hit the strike.
Most definitely. Hey, David, do you still have your XLK?
Yes, I do.
You got what, the 135?
Yeah, I got the 135 for 2023.
So let's look at the 135 options chart. So it's been all the way a little bit past $16 or $1,600. It's now $1,350. So if you wanted to even buy this is still at a decent price. It's in the middle, you know, it's not at the high and it's not at the low. It's in the middle. And going into 2023, you know, I expect our price target for XLK for 2023, or it's going to be closer to the 160-ish. It's going to be past 160. So, you know, having the strike price of a 135, you're going to be golden if you pay $13.50 and you want to be a little bit more secure. So if we put the study on here, we're a little bit above the moving average, the 20-day moving average, just a little bit, but you're not getting this at a bad price. You know, you have $300 of reward just for it to go back to its old highs, and then XLK is going to keep trending higher in 2022. So you have a lot of time. So that's a good option. It's a good option pick.
Hey, and one more thing, you said that we don't have to be in a rush to hop in any of these contracts, right?
No, you don't. Just buy when you have, because you can't make yourself feel bad about, oh, it's quadruple witching and I don't have 2,500 for ARC. Well, shit, I might have to buy it in February when I have it. If I want it, I'm just still gonna get it. And my strike price formula might be different, but the market is not going anywhere. But for you who haven't got started at all, I recommend just either buying a stock like ARKK, just the stock, or trying to get that XLK option while it's still $700, because it could easily go to 1,000 easily, and then you will be happy when you got in at 700 and it's at 1,000.
But if you have the money, you have already been trading options, go ahead and pull the trigger for the stocks or the option plays.
Hey, and then one more thing, Jay, with the option interest, like the open interest, that's what it is. Does it really matter? Well, I know it matters because
It doesn't matter at all for the 2023s, because we're getting in before everyone else is thinking about it, and we're not really actively trading this. So once I get in the XLK, I'm not going to be hopping in and out of it. I'm planning on holding it for at least a year. So I'm not worried about the volume or the open interest. I'm more so worried about the volume of the underlying stock, to know if it's a good stock. Like if the stock is traded actively, enough each day. Like XLK is a better stock liquidity wise than Hero was. So that's why Hero it was harder to make money on, because it's newer. But we're not worried about like the open interest and everything, because we're the first to the party. And
Gotcha.
when you're the first, you have so much time that you can kind of just chill and relax. And then when the institutional money start getting in 6 to 8 months, we'll already be up 300%, while they just now starting to get in.
Well, could you use the open interest to determine what's a good contract or not, or no?
So you can, but when you're looking at leaps, no one's gonna be in them like that. No one was in ARKK when I bought ARKK. It was only like 300 people in there. Now it might be 1,000, 2,000. That's still nothing, So if you would have looked at that, you would have stopped yourself from making money, because you're like, oh, I need at least 2,500 people to be in here. No, I don't. Like, I'm cool with 30 people being here, because I did my formula and I stuck to my math, and that's what I think it can go to in the future.
Cool.
It's more so important when you're looking at like 3 month trades and stuff like that. Like it's not like I don't never look at it. It's just more important when you're looking at like shorter term trades.
Gotcha. And then I looked at this. This is my last thing. I looked at the SMH holdings earlier, and I saw one semiconductor was in there. And that was like the number one holding. I know the semiconductor space is kind of volatile sometimes, though. So,
but look at their performance. The SMHs actually outperform XLY and XLK, I believe. So you have to think the semiconductors are powering everything from the cloud to video games to artificial intelligence to microprocessors to everything. They're powering Alexa, they're powering your TV. So it's more so you're just getting exposure to a theme in the economy that is a must. The chips are in all the phones, they're in all the TVs, the MacBooks, they're used for 5G, they're used for autonomous driving, AI. So it's just a thematic exposure to something that drives the economy. And as we try to get into, supercomputing power and artificial intelligence, you're going to need that power to that chip power to boost the economy. So it's just another play. When you have something like ARC or something like that, though, they pick a lot of the companies that benefit from those companies. Me personally, I would buy just an AMD contract outright before I buy a SMH contract, because that's like the semiconductor I like. Or Taiwan Semiconductor is a good play by itself if you don't want to buy just SMH. Or NVIDIA contracts, they're on the pricier side, but AMD is my favorite semi besides Nvidia. And AMD's contracts are not just so terribly expensive.
This was a very
Hey,
informative
Duke.
Market
Hey,
Monday.
Duke, imagine if you would have had options on Disney recently.
Man, that would have been crazy.
Just so you understand how options work, imagine you being up 30% on the stock and you buy the option and you're up 150% because of the leverage.
Right.
You're not doing, once you learn how to do stocks, you know how to pick stocks now. So you're just adding a little bit more onto it. So you're like, all right, I've identified that Disney is a good company. So instead of buying the stock, I want to control the stock, and I'm going to get in Disney share. I'm going to get in Disney options because they have the tailwind of their streaming numbers coming back to compete with Netflix. They have their parks coming back online as the vaccine comes out, so that revenue is coming back. Their cruises, the theme parks, as well as like new Marvel movies and everything, either coming onto Disney Plus directly or going on to or coming back to the theaters if we ever go back to the movie theaters again. That's just an example of like, if you're gonna swing, you might as well swing with a big stick versus pitter pattering around with it. Once you learn what you're doing.
Right. No, I was reading this article that said that they're expected to go up 260 million by 2024. So I'm just like, I'm curious if their stock will actually split at some point, because I was looking at their history, and so it's happened like 7 times, but I don't know, man. I definitely think you're on to something. You know what you're talking about, because I was definitely thinking about selling it so I could just get into another contract. I'm up like, I think I own like about 15 shares. I purchased $2. So I'm up like $800 right now.
Yeah, you're killing it with that. Like, you don't have to sell your shares, but it's definitely, if you want to sell your shares to get something where something like Disney is in it, like like a thematic ETF or something like that, it is an option in the future. Once you learn how the game is played, now you can go on to like you pass JV, now you're on varsity. It's just a different beast.
Right.
Shout out to everybody that bought their first stocks this year.
Thank you. Well, this was a great Market Monday. We can start wrapping everything up. Thank you all for everything.
Hey, James, before you go, can we title this? Can we start titling the YouTube like into 2021? Like, can we say like can we title this like how to pick a option for Quiet Witching, and we write the date, and then we write forward thinker stock picks for 2021 or something like that. Like so like when people go back to look on our YouTube, they know they have an idea of like what we were talking about in that episode.
That sounds